Hello and welcome to Primary Visions Network Monday Mac Review. This is Osama Rizvi, and today we're going to talk about a few interesting things. So first of all, last week we couldn't do a show because it was a US holiday, but I really wanted to speak about the term a rolling recession. It's a nice way to describe what's happening right now in the US and also in many other parts of the world. But I wrote a detailed research article for it on primaryvision.co. In the research articles, you can go check it out. Especially, made it free so that most of the people can read it. So building on that, there were a few interesting charts that I could see recently, and I wanted to really speak on those. So first of all, the European data for the gas consumption. This chart has been making rounds on Twitter and other social media networks, LinkedIn, and it claims that despite all the challenges, European economies have managed to save about 19% of gas instead of the mandatory 15%, which is quite impressive. But this comes without any consequences, which by which it is meant that there has not been a drop in any economic activity or output. And that really sort of didn't make sense or didn't sit well with me. So although I couldn't find anything proper on that, but I did some of my research, and you can see that. So there were 3 points, very interesting points. First of all, although the natural gas prices have fallen a little bit from their peak, but when you compare it to their averages from 2018 to 2019, and the previous averages, it is still 250% more higher than where it should be. So as the interest rates continue to go high, as the inflation continues to become more sticky, we will see a fall in the consumer demand. And of course, the industries would also be affected. Another thing was that there were quite a few good indicators coming out of Europe. But if you consider the manufacturing PMIs, they have been actually falling. You can see that Germany's manufacturing PMI is at a 3-month low. Similarly, France's PMI is, quite concerning, nearing 45. And this relates to the third point, which is that the good economic indicators or the good news coming out of the European industry is mostly those industries that are sort of making more, let's say, cars, semiconductors, and other such products which can be related to supply chain disruptions. But energy-intensive industries, such as wood, paper, chemicals especially, they are still lagging. There have been proper fall in production levels. See what is happening at BASF. It's sort of winding down. I mean, it plans to slash 2,600 jobs, curtail 200 billion euros in costs. So yeah, that's something I wanted to highlight, that on the face of it, it is good that that the European countries were managed to, save so much gas. But when you go deep into that, it does not come without any consequence. Another thing, of course, housing market that I wanted to discuss. Housing is shambles, 37% year-on-year fall, greatest since 1980 or something like that, a multi-decade low. This was a very interesting chart that showed what is happening in the housing markets. Another one, that housing market has lost about $2.3 trillion, which is a huge amount, needless to mention, but this is more than the 2008 financial crisis. So it really puts things into perspective, that why this is happening, because the demand is falling down. Why is that? Because on the consumer side, things aren't looking really good. The mortgage index, it has also collapsed, as you can see from this chart. This was also making rounds on social media and Twitter, and it was very important to discuss this. So this is the lowest level in 28 years. Once again, it highlights the fact that there's something wrong on the consumer end, and we need to look at that. And because that is where, for instance, US GDP, about 60 to 65% of the GDP comes from consumption. So you have to look at the consumption part. Major indices around the world are taking a plunge recently due to different reasons. Chinese demand has not been as expected. Of course, we have pointed it before as well in our shows and in our articles that as they have accumulated a lot of inventories of different things, we might not see an uptick in their demand right away. So that is one of the reasons. Another reason is this. So look at this lovely chart, and it's really insightful actually. So treasury versus the dividend yields. Why stocks will crash? So usually what happens is that the S&P 500 dividend yield is more than the treasury yield, and it's, as it says, no-brainer, makes it no-brainer to invest in stocks. But now this has started to reverse, and it is now 5% as compared to the S&P dividend. And we might see, and Morgan Stanley actually has said this as well, that they see at about a 25 to 30% correction in global stocks and equities moving forward, and we might see a huge sell-off in the markets in the coming days. Finally, the market sentiment tracker, you can see that this side, the recessionary side on the left side, which is bearish side, the factors around this continue to accumulate, while I couldn't find any majorly optimistic new ones on the right-hand side, which is the recovery or bullish side. So housing market is down. Reserve Bank of Australia is also raising interest rates. There was a paper recently which said that Fed cannot tame inflation up until 2% without inducing a recession, which makes sense. PCE, personal consumption expenditure, which is the preferred measure by the Fed itself, came out higher than expected. Wage pressure is still building up. I'll write about it next week. Money supply is falling. Manufacturing PMIs are falling. So the market outlook remains, if not a recession, then certainly a rolling recession. So that's all from my side today. I'll see you all next Monday. Until then, take care.